Hi everyone, welcome back to my channel. Today's video is primarily about the ways to consistently make money in the market. I know it can be tough, especially when you're first starting out, so I want to discuss the value in learning the actionable steps to take to generate profit every time you trade, or at least put you in the best position to do so. So let's jump right into it. As y'all can see, I have Tesla pulled up here on the chart. So the very first concept I want to discuss is trading during liquidity zones, not just the market hours. Now, these specifically are price areas where orders are heavily concentrated. So I mention this because when you first spot these zones, you're really just setting yourself up for success. So let me give you a quick breakdown of what this means. We can see here at the start of the market, there was some bearish sentiment, but quickly buyers took control and we saw that the sentiment shifted to bullish. However, it was short-lived, and we can see that sellers took back over control. And with that, we see that this specific sell-off actually held to a key level that I already had pre-marked. So this 335 price level was reached at 8:44 a.m. And we can see this bearish candle here with this long body did not break below the 335 price level. The following candle here at 8:46 a.m. was in fact bullish. However, it only wicked below the 335. But if you notice, the body of the candle did not open or close below this 335 level. Essentially, it rejected off this level, and we can see that it entered into an uptrend. Now, one of the clues that this was likely to take place is going to be here with the volume. Again, going back to it at 8:44 a.m., we saw this large spike in volume. And we know that can usually be a sign or at least a clue that there may be some sentiment shifting, especially if it spikes at an extreme level in comparison to the previous set of volume. And we can see that take place here. So this provided a pretty good indication that the market sentiment would shift. That in combination with the fact that it reached the day's low, and of course the price was already at a key significant level. Now generally, most traders think open to close, but the true money is in stacked order flows. And it's no secret that this is more likely to happen during the first 90 minutes of the market and the last 60 minutes of the close. So because it may be tempting because the market has slowed down, instead of forcing trades midday, which we know is often when stocks consolidate, not always, but more frequently than not. But you can track where liquidity is trapped. For example, with open range breakouts, you want to map the high and low from 8:30 a.m. to about 9 a.m. And most of y'all know that I'm in Texas, so I am on Central Time. But institutions use that window of time to position size. Even during the last hour of trading, they set traps that create fakeouts before the real move is set, which is why you'll tend to see a huge spike or decline post-market, and it's usually like an over-exaggerated move. So an actionable tip is to write down the time of day performance. If 70% or more of your wins are between 8:30 a.m. and 10 a.m., you may want to eliminate everything else. You don't have to, but it's best to get great at one style of trading by being consistent first. And I can't tell you the number of times I've heard people say that they only trade during a set amount of time throughout the day, and then they've traded outside their preferred time periods and nearly instantly regretted it. So discipline will take you so much further with this technique. Okay, so the second tip is to build a pre-market heat map of key levels. Hence why you see these blue horizontal lines here that I already have traced as key zones. And of course, these have been used as my support and resistance zones, and that's based upon supply and demand, historically on what I've seen happen as far as patterns. So you don't want to just track yesterday's high and low singularly. You ideally want to layer 3 types of levels. One is liquidity sweeps, and these are wicks above or below prior higher lows. Second is volume areas from pre-market where big money was building. And third is to keep in mind the VWAP anchor resets from prior day. Now you can create this heat map each morning with 3 to 4 exact zones and only trade when the price interacts with those areas. And this will help to avoid chasing moves. And if need be, you can actually take a look at Market Watch and you can take a look at the heat map that they have here already listed for you. If this will help you at least understand what's trending in what direction, this can provide at least an overview of what's going on in the market. Because obviously the green boxes will show you that there's extreme bullish sentiment, and then red will show you that there's obviously some bearish momentum. Now with that in mind, you want to take advantage of the second chance entry as well. Most new traders get shaken out on the first breakout or breakdown, and those are likely just rookie mistakes. And that's because institutions run stops in those areas purposely. The real move is often in the second retest, since it may at times come with stronger conviction. So think of it like this: the first push is the liquidity grab. However, the second touch is the confirmation needed. So it's best to wait for a second attempt at a breakout zone before sizing in. And what you'll find out is that this helps you cut down on fakeouts massively. Now, next up is going to be reading delta shifts instead of lagging indicators. So just for a second, we'll act like the RSI and MACD are non-existent. For those who lean heavily on them, the moment you lessen your dependence on their confirmation, you'll force yourself to watch order flow pressure. And I'm not saying there's anything wrong with using them, I'm just saying sometimes trading with a bear chart will open your eyes to a new perspective. So what I like to draw my attention to is a strong breakdown with positive delta. And y'all know I like in the money contracts for specific trades, especially when it's strategic. So for the most part, a strong breakdown with positive delta, this means that buyers are hitting asks. But if price keeps dropping, this is a clear sign that the distribution phase is in progress. Now, on the other hand, a breakout with negative delta means sellers are hitting bids. But if price holds, this equates to institutions building up momentum about to soar it even higher. So for instance, you want to watch for delta divergence, and this is volume at bid versus ask prices, especially if you're like on the 2-minute chart. For me, that's where the hidden value shows itself. Okay, so next up, I do want to discuss building a no trade list. Most people build a watch list, which is completely fine, but in my opinion, it's equally important to know what not to touch. You should always avoid tickers with low volume and minimal indications of steady price action, because retail-driven names that are stagnant are felt the hardest. Also, y'all, skip plays that have already made a full measured move, because all that means is that you're late. No shame in waiting on another setup. So each morning, try to only keep 2 to 3 tickers with clean liquidity and volatility alignment on your radar. Anything more than that may just be giving you false hope. Okay, so the next tip is to utilize market microcycles. And you're probably like, what is that? It's just a way to recognize that the market has daily cycles inside it regardless of what you trade. So this can be highs, lows, or even consolidation zones. It can be a gap fill cycle. So if the stock's gap, the first push often retraces to that level or very close to it. You can additionally take a look at volume rotation cycles. Typically, the first high or low of the day almost always gets taken before trend forms. Historically, the market has just proven that to be true. And it's necessary to look at the end of the day positioning. Funds unwind and hedges start to relax. And with all the right information, it almost becomes easy to win when analyzing what the large money is doing to close out positions for the day. So you can track which microcycle repeats most on your ticker. No matter if you're trading SPY, QQQ, Tesla, all have different signatures. So trade that pattern only until it stops working. So for instance, if we're soon approaching Q4, you may not want to apply the exact same approach you would in Q1, even if it's for the very same stock or ETF, because seasonality trends are also something you want to make sure that you keep in mind. So keeping that aligned, the next step is position scaling like an algorithm, because this comes into play. Institutions have many different methods for building and creating strategic setups, so they don't always go all in at one level. They layer in and out at times, and you can mimic that by scaling. And that's not to say follow every single thing they do, it just puts you at the advantage to know the why behind what they do. So if you're entering into a position for a trade, you may want to start with a third size on the first confirmation. Now I'm one to look for a 3-candle sequence. So if you want to spot that familiarity, you may want to enter modestly at first. You can add another third when price resets and holds, and then add to your position with the final third only if it expands in your direction, hence breaking another key level. And what I like about this is that you don't have to time your entries to be perfect, they just have to be probable. By structuring your execution in layers, your P&L begins to resemble the controlled consistency of an algorithmic trade, instead of trading the volatility of a maybe or an assumption. And then the last thing I want to discuss is what I like to call the end of the day tape review. Most traders only jot down their wins or losses, but they may rarely go back to view the trade on demand or use the think back feature. Now, the important aspect of this is that you can look for where the liquidity flipped. You can also spot where buyers and sellers got trapped, and which trades are emotional versus which ones are truly plan executed. So even if you just spend 20 minutes on your trade review, it's the fastest accelerator to remove pointless trades from your game. So if nothing else, it's worth doing. So the bottom line is that winning daily is really just about trading in rhythm, liquidity timing, heat maps, pressure, and repetition. So if you build your playbook around these instead of hopeful setups, you'll win more consistently and lose far less often. So yeah, y'all, those are the 8 tips that I have. That's really all I wanted to go over. And that'll pretty much do it for this video. If you found any of this information to be helpful, feel free to leave me a comment down below. As always, I thank y'all so much for watching. And of course, I'll see y'all in my next one.